Vijay, hi, great to have you, Neeti. Thank you so much for taking the time out. I was quite taken by your note, which actually starts off with the quote saying, I can't change the direction of the wind, but I can adjust my sails to always reach my destination. We all know the kind of times that we're sitting in, both in terms of the global uncertainties with the changing interest rate regime that you're having, both in the Far East as well as the Far West, and of course, political uncertainties and geopolitical tensions other than that. But when we talk about India, it's really all about valuations. That's the sort of screaming amber light, if I can say so. What is it you're making of the market construct right now, especially here in India?
For having me in the show. So just to give you the context, from a demand perspective, last 3-4 quarters we have been excessively cautious, especially on the consumption factors. This is largely coming from the fact that household balance sheets today, we do not draw enough confidence because of excess leverage which households are sitting on. On top of it, if you look at the last 3-4 quarters, there is a weak job hiring when it comes to IT sector and weak salary growth. And adding to that, if you look at last 3-4 quarters, banks and NBFCs have been cautious when it comes to retail lending. All this are clearly putting a spanner on consumption growth. So consumption growth, which is one of the core pillar in the last 3-4 quarters, I think we do not see any legs for us to surprise positively as we move ahead, especially when it comes to urban consumption demand drivers are concerned. If we juxtapose that with the uncertainties which we are talking about, especially the political, the state elections which is lined up, and more importantly, the US elections and the impact of that for emerging markets like us is still not quite clear to us. As a result, we still seek better margin of safety, which is simply not there in majority part of the market, where we think valuations are pretty excessive right now.
So, what's the best approach right now? I mean, how is it that, long term investors who are listening to you right now try and sort of balance it out? Sure enough, there are those uncertainties. Sure enough, the valuations are high, but you've got to find the mean path, right? How is it that you find the margin of safety in the kind of exposure that you have right now?
Yeah. If I look at the long-term perspective, there are few, positive silver lining, no doubts about it. So if you step back, what are the things which are improving as we speak in the last 3-4 months? Liquidity, which is one of the problem statement, or deposits growth, which was one of the problem statements faced by banks in the last 6 months or so. That should logically seems to be settling as we speak, because government accumulated a lot of cash balances during the course of elections. That has started seeing some sort of spending. So this should logically mean liquidity environment should get better, which should be largely positive for private banks in particular. So on top of it, so one of the key thesis which we've been having pretty much for the last, say, 24-36 months, the entire private capex recovery. So if we look at the lead indicators, clearly suggest that be it sanction proposals lying with the banking sector as a whole, clearly draws confidence on private capex recovery. So I think these are the two important silver lining factors, which is very critical for the long-term macro standpoint. So that seems to be going the right direction at this point of time.
Right, morning. Now, given the fact that you did flag off the demand side concerns, just wanted to understand what the outlook is in the backdrop of the fact that, yes, there is the weak IT hiring, salary growth has been a little bit stagnant, exports as well. What do you believe that could play out for individual sectors, and what do you believe is going to be the turning point, or what do you believe is going to actually help to improve that momentum?
So what is happening is, if you step back and look at the last 3-4 months, what we are observing is, if you study the state fiscal priorities very clearly, so there is a clear impetus which has been given for freebies, especially the states which has gone for elections in the last 12 months and the states which are going for elections in the next 6 months. There's a lot more freebies which is coming back. This, mind you, this is coming at the cost of capex. So this freebies coupled with, so if we do channel checks around rural, so multiple channel checks suggest that rural related drivers are looking up. So if we combine the freebies on one side and rural recovery on the other side, so logically mass consumption, which has been struggling for the last 3 years, that should see a rebound in our assessment over the next 12-18 months or so.
Yeah, interesting. But then, the point that actually stands out when you talk about demand side concerns is that the government capex growth is actually slowing down. Uh, what kind of a bearing would it have on the entire capex related theme that the market has been so, fancied and obsessed about? I mean, do you think that they have actually seen their peak, at least for the interim period?
Actually, if you look at the last 6 months, what we have been recommending is the government is clearly very particular about consolidating their fiscal deficit targets. So, as a result, both central government capex and state government capex, incremental growth is going to moderate. This is pretty much our thesis, pretty much at the start of the year. But that will get balanced out by combination of private capex recovery. So what we are effectively trying to say is the best of the government capex growth is largely behind us, whereas the best of the private capex is still not played out in our assessment, especially from the large sectors like power, metals, semiconductors kind of sectors, or meaningfully participate in a private sector capex recovery.
Interesting. When you talk about supply side concerns, and you've highlighted as to how large companies are trying to fight it out and do whatever it takes to try and protect their market share, as are mid-sized companies as well fighting it out. We've seen that play out quite evidently so in the entire paint sector, and now two-wheelers as well are vying for the top slot, all of them pretty much across the board. What could it result into for some of these consumption spaces?
Yeah. Typically, if you connect the sequence between demand, supply, earnings, and valuation sequence, if you go back to slightly from 2016 to 2023, so India is clearly coming from an industry consolidation phase where we have seen multiple sectors where the top three, top five are gaining disproportionate market share. This market share, pressure, rather this market share accumulation largely resulted in these larger companies wanting to protect the market share. This is what is leading to capex recovery from the large sectors. On top of it, if you look at the last 12, 18 months, there is a clear improvement in balance sheet cycle of mid and small size companies. So mid and small size companies now to regain the market share. So they are also in the process of creating capacity. So because of this market share protection mindset, both from larger companies and from the mid-sized companies, so we are clearly in for a supply cycle. So importantly, what supply cycle does is supply cycle creates competition, and more importantly, fight for market share typically restarts in the supply cycle. So if you step back and look at three examples, private banks, paints, cement, all these three sectors, despite delivering good earnings in the last, say, 18, 24 months, that multiples got derated because of perceived supply coming in. So what we're effectively concluding is, in the last 5 years, from a demand-led earning cycle, we need to gear towards, supply cycle, and the supply cycle will be definitely negative for valuation multiples, because fight for market share can clearly result in pricing war between the companies. This could lead to, lower valuation multiples is something which we need to prepare for in the ensuing supply cycle.
Your take on the entire auto and auto ancillary space, and largely because of the fact that you do have the monthly sales numbers as well today trickling in. And as per your report, you've spoken about the higher agri income, the freebies, etc. What is all of that pointing towards? Because there was one time when we were talking very clearly about this premiumization trend really playing out. But basis the kind of findings that you have had with respect to mass consumption, what is it looking like for the auto sector?
Specifically, if you look at consumption, what we need to keep in mind is consumption is also seeing a lot of wallet share shift. Consumers are no longer going for the same consumption pattern which they had say 3-5 years back. So because of smartphones and its associated peripherals is becoming a larger category. So there is no clear pattern of consumption shifting back to specific sectors because of broad-based wallet share shift which is happening in the consumer wallet. So what is specifically happening in auto sector in particular is, in the last 6 months, we are seeing a clear shift towards economy segment of two-wheelers or entry-level cars seeing signs of pickup. So mind you, two-wheelers, fiscal year 25 volumes, if you add up, even if you annualize the volumes, we are yet to go back to fiscal year 19 volumes. So two-wheeler is definitely coming from a low base and it's creating a good cycle. So, and more importantly, if you divide the breakup of two-wheelers or four-wheelers, where the demand is clearly coming back is the entry-level products. And clearly because of weaker urban consumption, we are seeing the top end of four-wheeler demand or two-wheeler demand is definitely seeing some signs of moderation. So while the overall demand, while all the overall volumes looks interesting, but if you dissect the data, it is only entry-level products started seeing a comeback. So which is in line with the mass consumption recovery point, which I had earlier highlighted.
So, looking at the construct that you've just set out for ourselves, where is it that you think we're going to go from here? Especially because now, instilled by the stimulus, China is also a very big factor. And what would be your sectoral overweights and underweights in the market?
So sectorally, what we have been saying is that this is going to be a very tricky market, but every sector has got a lot of nuances. So I think the way we have approached, the choice of sectors of stocks is basically create a portfolio with a more of a barbell portfolio mindset, with 1/3 of weight going for quality managements, who can see through the adverse macro because of their experience of seeing through them in a successful manner. So the other 1/3 should be going towards quality cyclicals. Cyclicals which can benefit from private capex recovery, or cyclicals which can benefit from the real estate consolidation or real estate completion. So clearly balance the portfolio between 1/3 of weight between quality cyclicals and 1/3 with quality managements. And we also inclined to have some more turnaround companies. So that's the way we are positioned, or that's the way we are recommending sectors. But right now, if you look at where do we see margin of safety, barring private banks, there is no pockets of margin of safety or whatsoever in any part of the market. So valuation multiples have significantly re-rated, despite earnings moderation across. So as a result, at this point of time, there is only one pocket where we have good margin of safety, which is there with private banks.
Yeah, absolutely. That seems to be the case and playing out well in the market as well. But Vijay, thank you so much for taking the time out and speaking with us today.
Thanks a lot. Thanks for having me.
Okay, let's see what.
There comes a time when your heart calls for you to arise. Plant your feet solid into the ground. Decide your own limits. And then break right through them. Become something more. It's my time to rise.